Hey guys, welcome to another episode of Thinking Like a Bank, where we show you how to think like a bank using the same strategies and principles that banks use to help you find more financial freedom in your life. I'm your host, Sarah Ibrahim. With us today, I have a very special guest and a client of mine. His name is Victor Alves. He's a real estate entrepreneur and the co-founder of Vecno Capital. Vecno Capital is vertically integrated and has experience in managing all aspects of acquiring, renovating, and repositioning single-family, multifamily, and mobile home communities in Texas. They have a track record of delivering consistent returns to investment partners with over 100 successfully completed real estate investing projects since 2015. Vecno Capital has ownership interest on over 575 units in both single family, multifamily, and mobile home communities in Texas. Victor prides himself on creating profitable partnerships that positively impact the communities he operates in and help people to passively invest alongside them to create cash flow, build long-term wealth, and enjoy the tax benefits of owning real estate. Victor, welcome to the show.
Thank you. Awesome. Pleasure to be here.
Yeah, thanks for joining us. Before we jump into Vecno Capital and what you guys do you mind sharing your background and how you got into real estate?
Yeah, sure thing. So I'm originally from Brazil. So I was born and raised there. I came to the US to go to college with a tennis scholarship. I actually, fun fact, I don't share that a lot with people, but I actually played professional tennis when I was 17, 18 for a couple of years. Not a lot of success. So that's when I decided to come to study here in the US. And then 2 years into my college career, I decided that I didn't want to play tennis no more. So I went ahead and, started working in sales. I sold payroll and human resources for about a year and some change. And then we came across this, webinar about like learning how to invest in real estate from fortune builders. We ate it up and then basically got coaching and started how to flip houses and wholesale houses. And then we started, buying some rentals. And then, we transitioned, end of 2019 into multifamily and mobile home parks. So that's kind of been our focus outside of our property management company, which we opened end of 2019 as well.
Okay, nice. So you do two things. You run Vecno Capital and you have a property management company.
Yes. Yeah.
And do you manage properties for properties that you don't own for other people?
Yeah. So we do both. Yeah. Okay. I think like maybe 70% of our management or maybe a little bit more is our own stuff. Mm-hmm. And then the other things are our clients.
Okay. Okay, perfect. Okay. Now, is the correct term for you? Are you the general partner of Vecno Capital?
Yeah. Okay. Technically, yeah. And then it's me and my wife, basically.
Oh, okay. And then for the listeners who don't know, so I think there's two important terms, right? General partner and then limited partner. Do you mind explaining what those two terms mean?
Yeah. So basically that's more on the investment front, right? So the general partner or the GP, what they call it, is the people that are actually putting the deal together, doing all the management, making sure that day-to-day operations, everything goes smooth. And then the limited partner, which is the LPs, is the passive investors. So people that just putting the money to work on the deal and they don't deal with, any day-to-day basically activities of the investments, if you want to kind of divide it into.
Okay. And then so they're limited in the sense of work and then also limited in the sense of liability, right?
Liability. Exactly. Yeah. So I just said on the work part of it, but yeah, the liability as well is a little bit different because they're not getting the loan. They're not, a lot of other things.
Okay. And then, so for Vecno Capital, what are the types of investments you guys are focusing on?
So right now we focus mostly on apartment complexes and mobile home parks, specifically more mobile home parks than apartments, but we still, actively pursue both.
So I've actually interviewed a couple other people that do mobile park, they do syndication for mobile parks. So what is it about mobile parks that's like financially beneficial?
Yeah, well, outside of the better returns on the, on it and a little bit like less cost per unit, there's like the moat behind it, which is like there's not a lot of people developing new mobile home parks, which makes every mobile home park that you have more valuable, and also allows you to typically the tenants are going to stay longer because there's not much options for them. Um, Also, you're dealing with affordable housing, which is I really like. We get to improve affordable housing along with if you have if we have a crash or something, like you're in the bottom of the pool there, so typically everybody's gonna fall and you're gonna be like the net for everybody. And then outside of that, I think also too, think of it, what I use the term a lot, and then is that mobile home parks is like a parking lot mixed with an HOA, right? You're renting the lots, for our model, right? There's some other investors that will do like what they call the park own home model,
Yeah.
where they own the homes and they rent the homes out. There's a little bit more profit there. There's also a lot more work in that aspect, but like it's more of a parking lot. You rent the lots, you're only in charge of the general areas and the utilities, and then everything else is the tenant's thing. So it allows you to scale a little bit more. Your operational costs, 30 to 40% of, as opposed to a multifamily, you're looking at 50 to 60% at times. When it's well managed, right? Let's put it that way. And so that's kind of what we really like about it. It's low maintenance cost, great returns, and you're working with affordable housing.
Okay. And then, so affordable housing, does it mean that it's affordable, or is that more on, like, does it refer to any government funding?
Yeah, so it's actually affordable. So,
Okay.
if I'm not mistaken, I might be wrong, but I think the last time I heard is that national average lot rent in the US was $280 or $285 a month, right? And so, for example, in our communities, it will range, and we're here like around San Antonio.
Yeah.
It will range from like $325 a month to $475 a month. Okay. And so it's fairly inexpensive, for them to compare to, I don't know, an apartment complex that you'll be paying like a crappy one or so one, you're paying $900 a month, and the nicer ones you're paying like $1,100 for like a 2-bedroom, sometimes even for like a 1-bedroom apartment. So it's again, it's very affordable, and it's the only actual form of non-subsidized affordable housing, because you have like Section 8 on apartments, how in single family you don't have Section 8 for lot rent.
Okay.
So
Got it. Okay. And what are the typical, like, for example, like for one deal, how many parks places are in one like community that you typically work with?
Well, it depends. So like to be a mobile home park, you have to have more than one. So
Yeah.
it could start with 2. We like to, stay on the 40 plus, lot count. Our smallest one is 26 lots, and then our biggest one right now is 45 lots. And so that's kind of like, we like that 40 range. Obviously, we're pursuing a few deals that are close to the 100. Those are better, in the form that you get a little bit the same thing with apartments. It makes it a little bit easier to manage. You can have an actual full-time on-site manager, as opposed to like a part-time, or like what I call a park mama or park papa, right?
Yeah.
That just kind of keeps an eye on things.
Yeah.
But yeah, so that's kind of what we do. 40 plus is where we try to stay.
Okay. So just to get this kind of all together, so you have your limited partners, and then you invest with the limited partners. You buy, let's say, a whole community, you take it over, and then how long do you typically hold that for?
So on our pro forma for the mobile home parks is a 10-year hold. So we have a 3 to 5 year refinance where we plan to get, somewhere around 70 to 100% or more, but like of the investors' capital back, and then we hold it for a period of 10 years. So it's more of a longer term hold.
Okay. And then what do you guys do with it after 10 years? Do you sell it to like a REIT or like another syndication?
So yeah, it would probably be in the sense of, so we can decide. So on the parks, we try to keep it with a small group.
Mm-hmm.
So I don't have more than actually on the parks 2 partners. On the apartment side, we had more
Mm-hmm.
things, but like we don't have more than 2 people on the parks yet. But you get the option to, we can keep it for longer,
Mm-hmm. Mm-hmm.
right? Refinance again. You have the option to sell it, and it probably be a private group, unless we get big enough in one specific area that maybe a REIT would be interested in.
Okay.
And then, but yeah, so those are the 2 options: just sell it to a private group or refinance and do it all over
Okay.
again and keep it.
Now, because you guys are holding it for around 10 years, does it also mean that the limited partners are holding their money with you for 10 years?
Yeah, so yes and no.
Okay.
So we have the refinance event, which should, in our pro formas for the majority of them, get 70 to 100% of their initial capital back.
Mm-hmm.
So they should be getting, like, if they invested, I don't know, 400,000, whatever, in a deal, or 100,000, whatever, right? Depending on the deal, right? They should be getting 70 to 100% back within 3 to 5 years, and then the equity stays, whatever appreciation we created stays until the sale event happens. So that there's 2 different cash on cash returns that we're talking about. There's the full on sale, get the profits from the equity, and the management cash flow and the return while it's being managed.
Okay. So for the cash on cash return, like what is that typically like on a yearly basis?
So if you're looking at we usually offer, like, our investors, depending on the deal, between 6 to 8% pref. So
Mhm.
they're looking at that, depending on the deal. We'll do, and then it's typically like a 70-30 split,
Mhm.
with, after the refi, a 50-50 split. But you're looking at, like, on a total project after exits, about like 20 to 23 on the parks percent annualized with the sales event. And then during management, it will vary. Like, initially, where you do value add projects, you're
Mhm.
looking close to your pref, so like 6 to 7% to 8%, is where you're going to stay. And then after it gets stabilized, we're looking at between 9 and 12%, or 9 and 11%, cash on cash return. And this is just annualized, right?
Mhm.
Just through management. This doesn't include the sales event component of
Okay.
it.
So overall, what would be like the equity multiple? Like for example, for the equity multiple overall.
Yeah, so you'll be looking at, like, 3 times in
Okay.
the 10-year period, 3.2
Okay.
x.
Okay, perfect. And then aside from the growth of the investment, there are also tax benefits, right?
Exactly. Yeah, yeah. That's one of the funnest parts, that a lot of times, which it's funny, until I got into the whole syndication and raising capital for apartments, and on the park game, I didn't really put a lot of thought into how powerful that was for some people, to be honest.
Mhm.
And obviously, you have to invest on the asset, make sure it produces good profit.
Mhm.
But if you're starting to look at your when you do a cost segregation study,
Mhm.
and you start looking at your paper loss, man, like, that could offset quite a bit of your income, depending on who you are and how and what you do.
Mhm.
But yeah, it's extremely powerful to do, to have those paper losses at the end of the year, especially in the first year after we do the cost segregation study for the, for the park.
Okay. And then typically I think it'll help real estate, those who claim the real estate professional status, right? Those
Oh yeah,
get the most tax
the
benefits of it.
most. Yeah, and the great part about it too is that, you know, if you can't write it off all of it, or
Yeah.
if you don't need to write off all of it, you can always pass it along to the next year and have that negative start of the year, which is awesome.
Yeah. Definitely. Yeah. And so there's kind of so do the investors have to be accredited investors?
So they don't.
Okay.
Most of the syndications that we'll do and the deals that we'll do, you can be accredited or unaccredited. We are, like I mentioned to you before, a little bit um, before we're opening a fund soon. We don't
Mhm.
have the exact date yet, but that would be only for accredited investors. But right
Okay.
now, either one of theirs have to could invest. Obviously, for non-accredited investors, and and for if we're doing a 506B offering, we have to have a pre-existing relationship, so we have to be in touch a few times,
Mhm.
get to know each other a little bit better before you can actually invest in our deal. So
Okay.
that's the thing.
Okay, got it. And then so when you start a fund, is that different? Like explain more of that to me. What does that mean to start a fund?
Yeah. So what that means is basically you are, instead of like if you're syndicating a deal, right? You're going to be, you create a syndication for that specific property,
Yes.
and then, you raise the capital for that deal, and that's it,
Mhm.
right? On a fund is, you tell them, what the fund is going to do, and what in returns, and if there's prefs and splits, how does that work for the fund.
Mhm.
And then you go ahead and have investors invest on the fund, and then you go buy, right? Our fund, the way we're structuring with our attorney, is a little bit different. That's a traditional fund.
Yeah.
Like they invest in the fund, they put the money in, and then you go buy. The
Mhm.
benefits of the fund, right, is you can diversify more your portfolio, but you have very little control of what you're investing in, right?
Okay.
In most funds, because you can't choose like, oh, I will like this property, I like this property. You can't do that. You can do that on a syndication. Now, on our fund, what we're doing is we're doing like a SPV, so a single purpose value fund. So there's going to be the master fund or the mother fund,
Mhm.
and then we're going to have each individual property have its own placement. So our investors in our fund can actually choose which properties they want to put their money in and at what times, and then they're going to be able to invest. So instead of them just putting and just basically trusting,
Mhm.
us, like, hey, whatever they buy in that fund, great. They can actually pick where they're going to be putting their money from the mother fund. They have to sign in for the mother fund, but then
Uh-huh.
they'll invest in each property individually.
Got it. Okay. And then for the fund, they have to be accredited for that.
Yes, for the fund, yes.
Okay. And then for the actual properties themselves, it's under
Mhm.
506B, Reg
Yeah.
506B,
Hmm.
which means that they could just be non-accredited or sophisticated investors as
Yeah.
long as you have a relationship with them.
Correct.
Okay. Okay, makes sense. Yeah. So Victor, how can listeners reach out to you and learn more about you?
Yeah. So maybe the best ways to reach out to me is you can go to our um, website, which is vecnocapital.com. And then if you click, invest now, well, actually, technically, the best way to reach out to me directly is emailing me at victor at
Mhm.
vecnocapital.com. And if the other way you can also do, if you want to kind of be part of our investment community and get to know me and see what opportunities come in, it would go to our website, vecnocapital.com, click on the link, invest now, and I'll take you to our sign up form for the investor portal. And then once you get in there, then it'll instruct you to schedule a call, and then we can kind of start that relationship going for future opportunities.
It sounds good. I'll be sure to add in all the links in the show notes below. Victor, thank you so much
Cool.
for joining us, and I'm looking forward to having you back on
Sure.
the show.
Awesome, man. My pleasure.
To learn more about what we do and how we can help you grow more wealth, please visit www.finassetprotection.com. That's FIN assetprotection.com. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.